Hello, everyone. Welcome to another episode of Income Investors. My name is Moe and with me today is John Whitefoot. Before I go into any details, I want to let you know that anything you hear in this video is for information and educational purposes only. Investing comes with risk, and no matter how safe an investment sounds, there are risks involved. To read more about it, please see the description below. The real estate investment trusts, or they're commonly referred to as REITs, are popular with investors because they legally have to pay out 90% of their taxable income to investors in form of dividends. Even in high interest rate environments such as we are in now, REITs tend to do well, make money, from renting properties, property sale, and interest income. But that doesn't mean their stocks do well. Despite that REITs are throwing up solid numbers, share prices are down across the board. Over the past 12 months, the S&P United States REIT Index is down 16.9% and has lost 1.9% of its value year to date. Today, we're going to be talking about UDR Inc. It's traded on New York Stock Exchange under symbol UDR. But before I go into any details, John, do you mind telling me what is happening with REITs?
That's a good question. There seems to be a disconnect, but it seems to happen pretty regularly. Investors are probably worried about how rising interest rates will hurt REITs, but this isn't normally the case. Again, as you said, they can pass on rising interest rates to tenants in the form of rising rents, and they often flip properties when the time is right.
And, won't rising rates hurt REITs more?
Interestingly, it shouldn't. Most REITs hold a lot of fixed rate debt, which isn't affected by interest rate hikes. It is an issue, though, when the debt needs to be refinanced. But fortunately, REITs collectively have a weighted average term of maturity of more than 7 years, which is beyond the current interest rate environment. So this actually bodes well for REITs in 2023, not just because they have strong balance sheets, but after taking a big beating in 2022, REIT valuations are actually pretty low right now. And some REITs have more compelling stories than others. Some REITs are focused on commercial properties in major cities, undervalued secondary markets, middle-class housing, affordable housing, and retirement homes. But UDR operates in an area that's experiencing huge growth, and that's luxury apartments that cater to well-heeled renters.
So, John, you are saying that wealthy Americans are actually turning to renting over buying?
Yeah. And it might surprise some investors to learn wealthy people don't necessarily want the hassle of owning a home. You might think that people with lots of money would invest in real estate, but that isn't necessarily the case. And there's a lot of numbers to back that up. That's just not me promoting a particular, ultra high yield dividend REIT. According to the Wall Street Journal, rising mortgage rates and high costs have convinced some that real estate is too risky of an investment. In fact, the number of renter households earning $150,000 or more a year jumped 87% between 2016 and 2021, which is a huge number. And actually, in 2021, around 44 million households rented, and the median income for all households was roughly $71,000.
And I have to ask this: won't people skip luxury rentals when rents start to soften up a bit?
That's a good question, and the answer is probably not. The high costs associated with home ownership and low supply of homes for sales is likely to lead to more affluent people renting. Even high earners with minimum savings have more spending power than those with lower income, and they're turning to luxury rentals with views, rooftop pools, fitness centers, spas, screening rooms, and luxury rentals with close proximity to beaches and vibrant city centers. So not all high earners are going to pad their landlords, bank accounts forever. Some will buy a home when they find something that's better, but by all accounts, another high earner will happily take over their luxury rental.
And now let's bring everything together, and that this all should be good for a UDR, right?
Yeah. UDR, which is also known as United Dominion Realty Trust, is actually, as I said before, a luxury apartment REIT, and it has an ownership position in 58,411 apartment homes, including 450 houses or homes under development. The majority of its properties are located on the West Coast and the East Coast, like New York City and Washington, D.C. But you can also find their properties in places such as Austin, Dallas, Denver, Philadelphia, Portland, and Tampa. Yeah, and some of its swishier properties include Vision on Wilshire in Los Angeles, 399 Fremont in San Francisco, the Moe in Washington, D.C., and the residents at Pacific Center in Huntington Beach.
And how is UDR doing in this, high rate environment?
Well, perhaps not surprisingly, wealthy renters don't mind paying premium prices for luxury rentals. For the first quarter, ended March 31st, UDR announced that revenue increased almost 12%. Net income per diluted share jumped 125%. Funds from operation climbed 9%, and adjusted funds from operation grew 12%.
And what's happening for the rest of 2023?
For 2023, UDR reaffirmed prior guidance for strong funds from operation per share growth, adjusted funds from operation per share growth, and same store growth guidance.
And what's happening with its dividends?
Again, that's like, one of the benefits of UDR. Thanks to its in-demand luxury properties and reliable cash flow, UDR has been able to provide income investors with a reliable growing dividend. This past March, the board declared a regular dividend in the amount of 42 cents per share, or $1.68 on an annual basis, for a yield of 4.28%. For context, inflation is at 4.9%. So it's not quite a wash, but it's pretty close. And the March distribution actually represents a 10.5% increase over the 38 cents per share paid out in the same period in 22. What's also important to know is that UDR has a long history of paying a dividend. It's paid one for 202 consecutive quarters, and it's raised it for 13 consecutive years. Since 2010, the company's dividend has also expanded at a compound annual growth rate of 6.7%, which is significant.
Indeed. And, we talked about how REITs stocks or REIT prices haven't done so well. What's happening with UDR?
Well, it's tough to find a REIT that hasn't taken a bit of a hit right now, and UDR stock is no exception, down approximately 16% year over year. On the plus side, UDR stock is up roughly 3.75% year to date. The pullback has actually put UDR in a better trading range. Even our conservative friends on Wall Street think so. With a 12-month potential share price gain range of $45 per share to $50 per share, this points to potential gains of approximately 15% to 28%.
All right, John, thank you so much for talking about UDR Inc., traded on New York Stock Exchange under symbol UDR. It is an S&P 500 company and a leading multifamily REIT with a long history of delivering superior and dependable returns. It has paid dividends for 202 consecutive quarters and raised its dividend for 13 straight years. The outlook for UDR looks solid as well. There is an ongoing shortage of U.S. housing. There's an increased demand for rent, and more high earners are willing to rent rather than buy. Folks, that's all for today. We'll be back with another dividend play soon. Don't forget to like this video and subscribe to our channel.